Today is Tuesday, February 2nd. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. Where do we start? Give us the Elmo with the fire. Matter of fact, give us the nuclear bomb. There we go. We have massacres all over the stock market. We're going to talk about PayPal, of course, but look at what happened after the bell. Facebook is down over 20%. Good God. And it's not just Facebook. Snapchat is down. Twitter is down. Pinterest is down. Etsy is down. Amazon is down. Everything is down. The good news is Mark Zuckerberg got out in time. He sold his stock last year. Meanwhile, you are left holding the bag. Now, we're going to talk about Facebook in details perhaps in tomorrow's video. But before we do that, we're going to wait and see how the stock is going to perform tomorrow. For now, let's move on to cover PayPal. And here it is, in focus tonight. The PayPal Massacre. And let's start with this. The geniuses, the pumpers, the so-called experts have been saying to you that PayPal is a great value and you should scoop it up right before the crash. Namely, pumper Jim Cramer, who said to his so-called investing club, which is, by the way, the easiest way to become homeless, but the good news is we can use it as an inverse indicator. But Jim Cramer has been saying, PayPal, PayPal, buy PayPal. What do you know? PayPal comes down crashing the very next day. This is the same guy who told you to buy Bear Stearns right before the crash. Another one in Jim Cramer's greatest hits. He also told you to buy Netflix just before the crash. Yet there was somebody who've been warning you about PayPal, not just yesterday, but over a year ago. And this is what I tweeted back in October of 2020. PayPal is worth more than Bank of America. Square is worth more than Goldman Sachs. Totally rational market. And of course, back then you guys attacked me and said, what do you know, bro? You're just jealous. This is the future, bro. You don't understand. Kathy Wood, she knows. Okay, I play the long term, baby. Like this guy who's proven right again. Warren Buffett is having the last laugh. Why? Because fundamentals always matter. And this is what I said last time I covered PayPal's chart. Look at this. We have a double top at around 310. That was your warning signal to get out. The stock is topping. And then I showed you the trend line in yellow. And I told you, if that line is breached, run for the hills. It's over. And indeed, since then, the stock has been flushing down with no stop in sight. And the mania is coming to an end. Perhaps it already ended for certain names. We're talking about erasing all of the pandemic gains. Look at Peloton, down over 80%, Zoom over 70%, DocuSign over 60%, Block, aka Square, down over 55%, PayPal, down over 52%, Shopify, 44%, Netflix, 34%. And there is more pain to come. So what went wrong here with PayPal? Let's do the forensics. When you look at the earnings report that they gave us yesterday, the net new active accounts went down 39% year over year, and the earnings per share went down by a stunning 49%. And this is the GAAP number. The non-GAAP means the cooked number, which I don't pay attention to at all. Now, let's dig down further. The revenues for PayPal went higher year over year by 13%. Expenses, on the other hand, went higher by 14%. This is an alarming sign showing a company facing severe inflation. Not in the stock price. They're facing actual inflation in the economy. The problem is they don't have the pricing power, so they gotta eat it. This is an inflation loser. When your expenses are rising higher, then your revenues run for the hills. Not a good look. And all in all, the net income was down a stunning 49%. And this is due to something called other income or expense. What's going on here? Before we investigate further, how about the quarter over quarter numbers? Revenues were up 12%, but expenses went higher by 14%. And the bottom line, the net income went down by 26%. So what's all about this other income/expense that cost PayPal massive losses in their bottom line? Well, according to PayPal, they say, quote unquote, bad actors are responsible for all of that because they had to shut down 4.5 million accounts. Pay attention here. Something is really fishy. in all of this. PayPal executives say it's bots. Their outlook was inflated a few quarters ago because bot accounts inflated their earnings. And now, when they investigated, they found out that they have 4.5 million bot accounts. Really? PayPal Holdings said it closed 4.5 million accounts and lowered its forecast for new customers after finding bad actors, quote unquote, were taking advantage of its incentives and rewards program. Shares of the company fell by the most on record. The payments giant, which is also overhauling its marketing strategy, said it no longer expects to achieve 750 million active accounts by 2025. Abandoning a goal that contributed to a jump in spending last year on sales campaigns. Oh, really? The company has been exaggerating its numbers, fluffing up all of these earnings estimates and outlooks to prop up the stock higher so the executives can dump stock. Oh, yeah. And then now, when the stock is already down big and the executives already cashed in, they come out and say, oh, we now found out that there were bot accounts and scratch all of these rosy outlooks that we gave you before. Give me a break. The SEC must investigate this. Unfortunately, the SEC remains in a coma. Another alarming signal from PayPal's earnings. The problem was disclosed along with an earnings report that fell short of Wall Street's estimates, sending the shares plunging. The company said low-income customers are spending less as they struggle to keep up with rising prices amid the highest levels of U.S. inflation in decades. Da-da-da-da. What have I been telling you in this channel all along? The stimmies distorted everything and pushed these earnings higher. We will never, ever match up with these earnings and these profits and revenues that were propped up due to the stimmies. The consumer is running out of spending reserves. They have exhausted their stimmies. They have exhausted their savings. And now they're swiping those credit cards up and down, up and down, up and down to keep up with inflation, meaning their priorities will change. All of that spending on goods that they did not need because they had some extra cash, that's gone now. The consumer will only spend on essentials, and that will crush PayPal and any related online platform, be it Etsy, be it eBay, or here it is, the big one, Amazon. Continuing. Growth in e-commerce spending also slowed as supply chain disruptions affected shipping times and consumers did more of their shopping in stores during the holiday season. Why? Because during the holidays, and I've seen this with my own eyes, by the way, during the holiday season, I went to Best Buy and I've been shopping at Best Buy for years now. I have never seen it this packed. Why? Because consumers couldn't find the goods online. If they buy it online, it's going to take a long time, weeks, before they receive the goods. So they had to go to stores and buy whatever that's available. And with the supply chain woes and the delays, spending on online shopping will recede, along with physical store shopping, because once again, the consumer is running out of spending reserves. PayPal last year began offering its first ever sign-up incentives, handing out as much as $10 to encourage new customers to open an account. Why? To prop up their earnings and their stock price, so the executives can dump. Again, where is the SEC? But the firm's risk management team discovered that many of the accounts were being created by bot farms, a system fraudsters used to manipulate internet activities, a spokesman for the San Jose, California-based company said. PayPal immediately began closing those accounts and attempting to recoup the incentives from those customers. Yeah, good luck. The spokesman said, let's see how the buy now, pay later is going to work, right? How about buy now, pay never? PayPal said it will refocus its marketing efforts on increasing usage of its products among active customers. Run for the hills, abandon ship, goodbye. The company's saying there is no growth here. We have to juice up our existing customers. It's done. It's over. And here it is. The CEO been dumping. I don't want to do the math for you, but please, somebody do it for us in the comments section. I don't want to get a heart attack right now. I got a show to do. And again, we talked about this. PayPal is suffering because people are not buying stuff from online shopping platforms. Another ominous sign for Amazon, which is about to report earnings tomorrow. So be careful here. That doesn't mean that department stores are the way to go right now. The consumer had to shop during the holiday season, but now Nobody's shopping anymore. Inflation is surging out of whack. Goods are nowhere to be found. And oh, by the way, the consumer is running out of spending reserves. Here's the evidence. I've been sharing this with you for a long time now. Look at retail spending. We saw a massive pump during the round 1 of stimmies and then another pump in round 2 of the stimmies. The moral of the story is those stimmies inflated corporate earnings. And by inflating corporate earnings, everybody assumed that this is the new normal. Buy all of these stocks, push them higher because the fundamentals are great. Corporate earnings, be it revenues or profits, are surging, so you gotta buy the stocks. And we now know that that was wrong. This was a transitory pump. The spending is receding, meaning corporate earnings, revenues, and profits will also drop down. You put 2 and 2 together, and the stocks of these companies will have to go down to earth too. Oh, and by the way, on top of that, we have inflation, which is the Fed is trying to combat by raising interest rates and tightening the monetary policy. So yeah, a lot of pain ahead. And I know what you're going to say. By listening to all of this, you're going to say, okay, if the consumer is spending less because they're running out of reserves to spend from, then the demand in this economy will go down, and hence inflation is not a problem anymore. And you put 2 and 2 together, the Fed will not have to be so aggressive in tightening the monetary policy, and that's good for stocks, right? Wrong. Here's why. I've been teaching you this, guys, for a long time now. Inflation, once it's born, it's out of your control. It's out of the control of the federal government, and it's certainly out of the control of the Fed, absent of aggressive, keyword aggressive, Volcker-like tightening of the monetary policy. And doing so will crash the stock market and perhaps push the economy into a recession. But what I've been teaching you all along is, once inflation is born, it becomes a self-sustainable phenomenon. The key to controlling inflation is in the early stages. I gave you the example, by the way. Inflation is like a tornado. Once you see the cone, the Fed has to act and tighten the monetary policy, and inflation will go away. It's not going to be a problem. But if you wait till the tornado lands, it's too late now. The only thing you can do is aggressive tightening of the monetary policy, and even that is not a guaranteed remedy. We saw the cone of the tornado back in the first quarter of 2021. And back then, I released a video and I said, Mr. Powell, if you want to save the economy from inflation, kill the bull. Kill the bull. Start tightening the monetary policy and certainly unstop the assets purchasing program. Powell did not listen. He continued to say inflation is transitory. And now we have the tornado, F5, and it's roaming around the economy. Yes, in theory, weakening consumer demand leads to deflation in prices, but have you ever heard of the phenomenon we call stagflation? Here is a great piece that I read today on Bloomberg, and it's written by Richard Coxon. The article says, rise in inventories sound an alarm about inflation. The move does not signal waning demand. It shows how enriched higher prices have already become. As companies worldwide work to rebuild their stockpiles of goods, they're sending a message about inflation. The trouble is that message is far more worrisome than many people have concluded, and it poses a bigger than expected problem for policymakers and the markets. Consider last week's release of the US GDP for the fourth quarter. Those who thought that inflation would moderate and the Fed would not have to tighten the monetary policy as much as some have feared, myself included, pointed out that some 4.9 percentage points of the 6.9 growth, listen to this, came from an increase in corporate inventories. This, the argument goes, reflected slowing demand. Growth and inflation were thus likely to falter, and the Fed would not have to be as aggressive. Pay attention now. The only problem with this reasoning is that it is wrong around the world. In fact, the extraordinary thing about corporate inventories is not that they are going up, but they are, in many cases, at record lows. The effort to rebuild them is not just inflationary in itself. It also indicates how enriched inflation has already become. I've been telling you folks, this inflation is not a supply problem as the administration and the propagandists have been telling you. There is no such thing as a supply push inflation, and the reason is the supply chain is more than equipped to keep up with normal variations of demand. For example, if the demand shoots up higher, for transitory reasons, the likes of toilet paper in the beginning of the pandemic, yes, you see certain shortages and transitory inflation, and then the supply chain, which is more than equipped to catch up with the demand will do that indeed, and prices will normalize once again. Supplies will become ample. The problem is when you have non-stop demand, and the non-stop demand happens when the Federal Reserve, the central bank of the world, prints trillions and trillions and trillions and trillions of dollars out of thin air, flooding the economy with excess liquidity. What happens when you eat more than you actually need? Excess calories mean that you're going to gain weight. If you don't exercise, if your appetite don't stop and you continue to eat more and more and more, your waistline is going to inflate more and more and more. And this is exactly what happened to this economy. The Fed, by the way, to this day, have not ended the assets purchasing programs. Believe it or not, the Fed remains so-called accommodative. Unbelievable. Now you might say, wait a minute, you just said that the consumer is running out of spending reserves, meaning the demand will go down. And now you're saying it's a demand problem. Hold your horses. The demand remains sky high because the consumer continues to swipe those credit cards up and down, up and down. And so long as they continue to pay that credit card debt and they reuse the credit cards once again up and down, the demand is still here. But it will not match the Stimmy's demand. That was one transitory pop that inflated everything and inflation stuck. It did not go down as the Stimmies ran out. Another reason, the supply chain right now is overwhelmed to respond to demand that already took place, meaning you ordered your Peloton, you did not receive your Peloton yet, so the supply chain is still working to deliver your Peloton. The problem is, what happens if the stock market crashes because the Fed is tightening the monetary policy and now a lot of people are losing their jobs and that demand that was accounted for is now gone because the consumer is going to cancel the order. I don't want to spend more right now. I'm not going to wait till I receive my Peloton. I'm going to cancel that order. And now what? Companies are left with excess inventories, meaning more supply than demand. And number one, either they're going to have to eat the loss and hence we dip into a recession, prices go down, everybody loses their job, and we have a recession, or companies refuse to lower prices and they hold that inventory waiting for the economy and demand to recover, and hence the phenomenon of stagflation. Prices stay high where the economy goes in the dumps. But back to the article, here's the evidence that the writer is providing. This is the Small Business Inventory Satisfaction Index, meaning when you ask small businesses, are you satisfied with the inventory that you have right now or not, well, you see the number. More and more respondents are saying we're not satisfied. Matter of fact, this number is the highest in recent record. What does that mean? Small businesses are seeing high demand, but there are no inventories. There is no supply. Everything is stuck at the port. And again, it's not because we don't have factories or the ships disappeared all of a sudden or port workers and truckers all died by the virus. That did not happen. So it's not a supply problem. It's an excess demand problem, which is adding more pressure on the supply chain. Why? Because the Fed remains accommodative, remains flooding the system with excess liquidity, and that liquidity goes to chase goods and assets. Too much money chasing few goods and assets, hence inflation. Another piece of the evidence. When we look at the manufacturing and trade inventories to sales ratio, it is way down. This is the lowest reading in many years. What does that mean? Companies are running low on inventories. Another important evidence that low inventories is yet another indicator that there is more inflation to come is this one. The price index for final sales to private domestic purchases. Prices are moving higher, the highest on record. What does that mean? The demand is sky high, supplies nowhere to be found, hence prices go higher. And all of this, by the way, is in the pipeline, which means there is more inflation in the pipeline. The author concludes by this: fearful that markets will plummet, central banks are horribly late in tightening monetary policy, and the longer they wait, the higher costs will be. Don't forget, inflation is a lagging indicator. Slowing real demand is not the cause of lower inflation, but the result of high inflation. Central bankers and markets have not yet fully grasped what it will take to wrestle the inflation beast to the ground. It's going to take a lot of rate hikes, and it's going to take the Fed reducing the balance sheet dramatically, and it's going to take the Fed ending all of their assets purchasing programs, and maybe, keyword maybe, inflation will go down. In the meantime, all of these actions by the Fed will 100%, forget about 100%, 1,000,000% will crash the stock and real estate markets. And here's the take once again. The supply chain is so overwhelmed right now to respond to out-of-whack demand. There's a lot of inventory in the pipeline being manufactured right now, being planned right now to respond to the out-of-whack demand. My fear is what happens if the Fed indeed tightens aggressively, crashing the stock market. We know that we have an economy that traces the stock market, not the other way around, which is supposed to be, but after the Fed's engineering of the stock market and the economy, unfortunately, it became that way. So when the stock market crashes, we will see millions and millions of jobs being lost. When people lose their jobs, all of a sudden that demand plummets. All of that supply in the pipeline will hit the market, and what happens then? We have the inverse problem. The market will become oversupplied and the demand is nowhere to be found. And once again, companies will have to either hold that inventory, waiting for the demand to recover, or they're going to have to eat a loss by selling that inventory at a much lower prices, because remember this, it cost them a lot to produce this inventory because it's been produced under high inflation. And now, by the time it hits the market, there is no demand. Either way, whether the companies hold the inventory or eat the loss, it's a bad outcome for the top and the bottom lines of these companies. They're going to lose revenue and they're going to lose profits, meaning their stocks are not going to perform good. We have a lot of pain to come here, folks. And of course, who is the winner from all of this mania, the everything bubble that the Fed has created? Certainly, it's not the mom and pop investors. Certainly, it's not the retail investors, the morons, Robinhood idiots who've been chasing meme stocks and garbage stocks, the future bro stocks. They're holding massive bags now. Their stocks are down 80, 70, in certain cases 90%. This is who wins from these manufactured cycles of booms and busts. The bankers, the Wall Streeters, the rich. The headline reads, bonuses rain, Wall Street bankers in biggest payout in decade. They're literally partying. The banksters, the criminals, they got your money now. This was a mere process of transferring the wealth from the poor and the middle class to the rich. The rich got your money now. And oh, by the way, soon enough, you're going to lose your job and you're in debt. A lot of pain is coming here, folks. But let's end in a positive note. Remember Snake, Bill Ackman, who's, by the way, an advisory to the Federal Reserve of New York? Not just him, but Ray Dalio and David Rubenstein. You want to talk about a conflict of interest? Here it is. The system is rotten, folks. The system needs to be uprooted. You cannot fix the system anymore. But here's the good news. Snake Bill Ackman is down 8.2% last month. Anyhow, folks, we're going to move on here and cover the market information for you, and we start with the performance. And here we go! The Dow Industrial Average closed in the green by 224.9 points, or a gain of 0.63%. The Nasdaq also closed in the green by 71.54 points, or a gain of about a half a percentage point. The S&P 500 also closed in the green by 42.84 points, or a gain of 0.94%. What about the sector's performance today? Leading the pack at number 1 and capturing the gold medal, Communication Services, aka Google. The number 2 for the silver, REITs. Number 3 for the bronze, Utilities. And the laggard of the day was Consumer Cyclicals. What about the advance to decline ratios? NYSE 44% advancing versus 54% declining. The Nasdaq, look at this. On face value, the Nasdaq closed in the green, yet we only have 28% advancing versus 69% declining. This was an alarming signal during the day. Why is the Nasdaq higher while we have only 28% advancing in the breadth? The answer is the Nasdaq was higher based on few names, namely Google, aka Alphabet. Moving on to commodities, futures, what's going on here? We have muted reaction in crude oil futures, be it the WTI or Brent. Today we got OPEC meeting. It did not last long. It lasted about 15 minutes, and they decided to keep the plan as is, meaning let's just wait and see how high prices are going to go. On face value, they say we're going to raise the output, but it's easier said than done. Countries where the supposed increase in output is coming from, they're saying, well, we're struggling to increase the output because once you shut down wells for a prolonged period of time, it's really hard to to ramp up the supply so fast. So the expectations for now, crude oil prices will move higher, and I have more news for you in a minute. But before we do that, gasoline prices were higher along with heating oil, and look at this, natural gas prices exploding higher by almost 14%. And guess who predicted that, by the way? Let's go back in time. Look at natural gas prices. Yes, they went down, but they're still up 150% since their bottom back in 2020. And my prediction is natural gas prices will curl back higher again, just like we saw with lumber. Again, this is the nature of inflation. There is no such thing as a transitory inflation. And here it is. Since then, natural gas prices are up by almost 50%. Unbelievable. If you're buying the dip in the NASDAQ and RKK, Mama Cathy Wood, you're an absolute fool when you can buy the dip in these assets that continue to move higher and higher and higher. What about softs? Look at lumber, moving higher again by almost 5% today. Likewise, we have gains for cocoa, coffee, and OJ. Perhaps OJ is finding a bottom here. On the other hand, the decliners were led by sugar and cotton. Bad day for sugar, not acting sweet, and the reason is, I shared it with you a few days ago, the supply is ample for sugar, at least for now. What about metals? What's going on here? Modest gains for gold and silver, yet we have notable gains for platinum, copper, and palladium, gaining about 1% apiece. What about meats? Big gains for live and feeder cattle futures, and here it is, the new big tech, lean hogs, shooting up higher and gaining almost 1.5% today. We're closing at around $100 for lean hogs. What about grains? A down day for corn and wheat, while we have soybean meal, soybean oil, and canola on the flat line. On the other hand, we have gains led by rough rice, oats, and soybeans. Let's cover some commodities news today. We have crude oil inventories came out short, yet another tailwind for prices to move higher. And we're watching closely the Texas deep freeze, which is about to intensify tomorrow. It's going to be a rough day in Texas, and this is pushing natural gas prices significantly higher. We talked about the shortage of supply in Texas. How could they not see this coming after last year? And it's not just Texas, by the way. This is one big storm that stretches all the way from Canada, almost, all the way down to Texas. Gas supplies in Oklahoma, the Texas Panhandle, and Arkansas tumbled 22% on Wednesday as frozen pipelines limit the flow of fuel. After a brief reprieve, colder than normal weather may descend from Texas to Maine from February 12 all the way to February 16. Ice cold. Meanwhile, here I am in California with blankets, sweaters, socks in a 60 degrees weather. Anyways. Moving on to the big casino, the options market. What's going on here? The volume remains way down, and this has been the sticky part of the so-called bear market rally, because the sustainability of any rally depends on the options market. If we're seeing participation of buying calls from the retail crowd, then we could say safely that we're out of the woods. But this has been the alarming signal that this is a bear market rally and market participants are not buying calls aggressively. The majority of the buying, by the way, is happening in a very short term, meaning buyers are buying strikes with the expiration of next week, February 18th, maybe March 18th at the most. But there is a lack of conviction here in buying calls. Regardless, at number one, the hottest table by far is AMD with almost 1 million contracts traded today. About 70% of those were calls. And at number two, Apple with about 870,000 contracts, about 64% of those were calls. Tesla, the souffle, at number three with around 700,000 contracts traded hands today, about 51% of those were calls. And here are the unusual activities that took place in the options market today. We start with the ticker DKNG DraftKings. A decent rebound in the last few days, along with the RKK names and many other names. The problem is, in a bear market rally, you're gonna flush down again. And somebody's betting on more downside to come for DraftKings. They're buying the 19 puts for the expiration date, February 18th, with the expectations that the name could drop down by more than 13% by then. They paid about 60 cents apiece to enter this trade, all in all spending about $1 million. And what about the trade for the ticker KWEB, the KWEB? This is the Chinese technology ETF. Somebody's betting for more downside here by buying the 29 calls for the expiration date, February 14th. With the expectations that the name could drop down by more than 21%, they paid about 75 cents apiece to enter this trade, all in all spending about $750,000. And what about the trade for the ticker Qualcomm? The name reported earnings after the bell, and last time I checked, the name is down. So say a prayer to the trader here, because they bought the 200 calls for the expiration date February 11th, with the expectations that Qualcomm would pop higher by more than 6% by then. And they paid about $5.50 apiece to enter this trade, all in all spending about $5.5 million. Wow. What about the ticker HOOD, the Robin Hood? Popped higher, Mama Kathy bought the dip, and now she's receiving a nice buy right in the face, per usual of course. Somebody's betting for more downside for the hood here by buying the $13 puts for the expiration date April 14th, with the expectations that the name could drop down by more than 7% by then. They paid about $1.85 apiece to enter this trade, all in all spending about $1.4 million. And lastly, what about the ticker OIH? This is the oil and gas ETF. It's actually oil services ETF. Somebody's betting to the downside here. Interesting. They're buying the 200 puts for the expiration date April 14th, with the expectations that the name could drop down by more than 14% by then. They paid about $7 apiece to enter this trade, all in all spending about $4.5 million. And before we move on, say a prayer to those who spent millions and millions and millions of dollars buying Facebook calls with 2 days till expiration, expecting Facebook to report decent earnings, just like Alphabet. Well, it's not happening. And we're about to see billions, forget about millions, billions lost tomorrow alone, namely 250 billion at least out of Facebook market cap. We're moving on to the heat map analysis. What's going on here? My hunch is the massive crash in PayPal, almost 25% today, triggered some margin calls. And you can see the losses in the software names. Shopify down almost 10%, Netflix down, Uber down. A lot of the high beta, high multiple names are down big. My hunch is the drop in PayPal triggered a lot of margin calls, and a lot of investors woke up to a nasty surprise. And we will see more margin calls to come. I'm talking to you, Tesla. The outperformers are the big cap technology names on the heels of Google's earnings. Likewise, we saw chips moving higher today. Along with the inflationary stocks, we're talking about banks, not the big banks though, healthcare, industrials, some materials were outperforming today, and the consumer giants, of course, Coca-Cola, PepsiCo, Procter & Gamble. Remember what I told you before. You gotta avoid any stock, any company that has exposure directly to the consumer right now. Why? Because the consumer is running out of cash. That's number one. Number two, inflation and the supply chain woes are going to slow down spending. So you got to be really picky here and avoid anything with a direct exposure to the consumer, meaning PayPal, Amazon, the stores. You got to avoid those. The only stocks you want to own right now with direct exposure to the consumer is the inflation-proof stocks. Which one are those? You are a consumer. Think right now. With this inflation, are you going to go out and spend on clothes that you're not going to wear? Or are you going to spend on essentials? You have to go to the grocery store. You have to pay the essentials. Food, toothpaste, detergents, etc. Who is the manufacturers of these goods? The answer is the consumer defensive names, the consumer staple giants, Procter & Gamble, Kimberly-Clark, PepsiCo, Coca-Cola, Mondelez, Costco. All of these names are inflation-proof. On the other hand, the online shopping, that is not essential. That is not inflation-proof. Take a look, for example, at Etsy, a name that I'm short right now, down over 9% in a single day. eBay down, Wayfair down. A lot of these online shopping retailers are down big. And the biggest iceberg that's about to drop is Amazon. Wait till that one drops. Another contrast of performance between value and growth. Take, for example, the auto manufacturers. Tesla down big, NIO down big, Lucid. All of these speculative names are down big. What's working, on the other hand? Toyota, Honda, the value names. Even GM and Ford are not value right now after the insane runs they had before. But Toyota, Honda remain value. Moving on to the heat map for the ETFs, when we talk about Toyota, Honda looking for value, Look at international markets. Which ones are moving higher today, outperforming? The answer is the EWG for Japan. The EWZ Brazil went down today on overbought technicals that we discussed in yesterday's video. Yet we have gains for developed market, European market, Asian Pacific, all moving higher, be it modestly. When we look at the ETFs in the US market, chips are up big today. The SOXL up over 7%, but perhaps you want to fade the gains here after Qualcomm's earnings. Likewise, we're seeing XLV Healthcare up, REITs, utilities, the consumer giants, the XLP, energy, everything is up today, with exceptions, the XBI, biotech, and the XRT for retail. You gotta avoid these like the plague. They're not gonna work either way. There is no big contrast between value and growth, although value outperformed growth slightly. My hunch is, after Facebook's earnings, the market will go down and we will see value outperforming growth once again. Moving on to charts, and we start with the 30 minutes chart for the SPY, the S&P 500. It gapped higher today and it retested the support of 445 over and over and over again before getting the permission to move higher to retest the resistance at 459. It did not happen. We ran out of time. And the problem here is, I told you before, when you look at the RSI indicator from a 30 minutes perspective, even from the hourly perspective, by the way, we're getting overbought just like that. And I explained to you, charts can work out these overbought conditions from the 30 and hourly charts in three ways. The neutral way is a pullback and then perhaps a recovery. The bullish way is consolidation, which the chart has been doing for a while now. The bearish way is a gap and crap. We did not have the crap part. We had a gap, a move higher again, pushing those overbought conditions to become even more overbought, meaning we're now waiting and waiting for a drop to fix all of these overbought conditions. Now, when we turn off all of these lines and markings, we switch to a line chart, are we seeing a bear flag pattern, which is supposed to take us down? This is at least what the bears are hoping for. They have a lot of ammo right now from the overbought conditions on the RSI. When we look at the daily chart for the continuous contract on the S&P 500, again, it looks good. The volume is receding. The chart recaptured 4,549.5 as support. The problem is the massacre that happened after the bell. And as you can see for now, even though the chart pretty much closed at the highs of the day, you're seeing a curling down in the RSI indicator after the opening of the new candle. So we're seeing signs of topping here. If the dip buyers don't show up tomorrow in the morning, we're going down, or perhaps we will mark the end of the bear market rally. Moving on to the Qs, 30 minutes chart, and I tweeted this in the morning. I said, the QQQ is showing signs of stalling despite the pop from Google. It should have been the tide that lifted all boats. This is not what we saw today, and this was an alarming signal that the rally is topping. When we look at the chart, we saw a gap and then a little bit of a crap, retesting 365.5 for support, and then rebounding and closing pretty much at the resistance of 369. The problem is we closed below the high of the day. So are we seeing a bear flag pattern that is supposed to take us down? You combine that with the overbought conditions on the 30 minutes chart. You put two and two together, and a pullback is imminent now. And right after the bomb from Facebook, it is now a certainty. Now, let's do the same exercise that we did with the SPY's chart and turn off all of these lines and markings and switch to a line chart. Is what we're seeing right now a formation of a bear flag pattern? If it is, then we're going down. Here's the daily chart for the continuous contract of the Nasdaq. We're seeing the death cross marking a change of the previous sentiment. When you see this kind of candle, it's not the end of the rally, but it is a pause where market participants have to think. Do we have the fundamentals, the momentum, and anything else that supports the last few days? Meaning the move higher? And if not, then we're going to sell, book profits, or we're going down. And it's already happening after the disaster for Meta, and the chart already lost 15,000 as support. And watch this. The volume spiked higher. This is bearish sign number one. Bearish sign number two, the RSI indicator did not reverse the negative divergence that has been going on for weeks now. So the bears, slowly but surely, are closing in here. And the next support we're looking at is 14,445. Moving on to a 30 minutes chart for the IWM, the Russell 2000 small caps. I tweeted this in the morning. that we have three worrying signs that the bear market rally is getting closer to an end. Number one, Bitcoin is down. It has been a spot-on leading indicator. If we are indeed in a risk-on environment, then why isn't Bitcoin moving higher? Number two, the Russell 2000 was down more than 1% early in the day. This was the leading indicator. Number three, the market was not so excited about Google's earnings, even with the stock split, which used to excite the morons before. Not anymore. Here's the chart for the IWM. It gapped higher in the morning and it produced a gap and crap, unlike the Qs and the SPY, and now the chart is forming a bear flag pattern. It is working out the overbought conditions in a bearish manner, meaning sooner or later we're going to go down to revisit the support of 196.5. Dixie, the dollar index, what's going on here? It is now retesting 96 as support. We'll see if it's going to hold or not. If we have another sell-off, perhaps this will push the dollar a little higher. And for now, gold is not doing anything at all, despite the move to the downside by the dollar. For now, I'm keeping my bear flag that gold could flush down or retest 1,763, but we better see buyers right now. Where are you going to hide? Stocks are not working. Bonds are not working. Bitcoin is not working. We have oil. That's working for now. Commodities. But what else? At some point, sooner or later, despite the hatred for gold, you're gonna have no choice but to hide in gold. And here's the daily chart for the US 10-year yield. We still have a double top. We still have overbought conditions on the RSI and MACD indicators. But look at how the chart is working out the overbought conditions. It is doing so via consolidation, baby. Uh-oh, what does that mean? Perhaps the 10-year yield will pop higher again. It continues to hold at 177 for support. Here's a weekly chart for the TLT. Bond prices moved a little higher today, but it remains a negative candle way below the trading range of last week's candle. So I would like to see a retest of 140, and if that happens, 140 will probably not hold because what we're seeing right now is a formation of a bear flag pattern. What about the VIX? 4 hours chart, we did not go all the way down to 20, but the ABC pattern played out and that produced a pop in the SPY. Look at the MACD indicator from a 4 hours perspective. Is it curling higher? Yes, it is. Are we seeing the red impressions on the histogram getting shorter and shorter and shorter? Yes, we are. Is the RSI indicator also curling up higher? Yes, it is. And we're seeing more green candles from a 4 hours perspective. This is a bottoming process for the VIX, which means we could soon see a topping pattern in the SPY. The VXN, the VIX for the NASDAQ, once again, look at the MACD indicator. The red impressions on the histogram are getting shorter. The RSI is curling a little higher. We're starting to see green candles. Perhaps the VXN is catching a bottom. And if it does, then the Qs are topping right now. These are your leading indicators that the bear market rally is coming to an end. What about Apple, a daily chart? It is trading above 172.4, my number, and so far so good. It looks bullish. There's nothing wrong with Apple. The problem is, if Google goes down tomorrow, if Facebook is down big tomorrow, then we will see the Qs down and Apple will be sold either way. And we have to watch out for 172.4 as support. Tesla, the souffle, an hourly chart. What's going on here? We were watching a bull flag pattern, and the chart moved higher. Matter of fact, gapped higher and formed the bull flag. A bull flag pattern is pretty much a process of the chart asking any buyers, any buyers, any buyers. Folks, we gapped higher. The worst is behind us. If the buyers don't show up, then the bull flag pattern will fail. And this is exactly what we're seeing right now. So we're taking the bull flag out of the picture. In matter of fact, I did buy puts in the souffle today. Here's what I'm seeing from a 15 minutes perspective. The bull flag is turning slowly but surely into a bear flag pattern. And if that happens, then the chart's going down to retest the trend line in yellow. And if that doesn't hold, then we're going down to close the gap at around 846. And this is my bet here. I'm buying puts with the expectations that Tesla will go down to close the gap. And we have more bad news for Tesla here. A black and gay woman is now accusing Tesla of festering bad working conditions. I cannot say the word because the robot police will go crazy, but you get the picture here. This is not the first time we have a minority worker that accuses Tesla of festering bad working conditions. Not just Tesla, by the way, even SpaceX. Just a few weeks ago, we heard from a female worker at SpaceX also accusing the company of bad working conditions. Next, we have Tulips BTC, and yeah, I don't like this. Not looking good. The bear flag is playing out. Soon enough, we're going to break below 35,750 unless we have a rotation from stocks to cryptos, which I don't see at all. And lastly, what about AMC? We had a bull flag. We were hoping that it's going to play out and the chart will retest 21 as resistance. It did not happen. The chart went down. The bull flag is dead. Oh, and on top of that, the chart closed the day below the gap. This is a bearish signal, not a bullish one. You want your charts to close the gap and then rebound from that point on. This is not what AMC did, but we have more bad news for the apes. AMC is now tapping the junk bond market for $500 million in a refinance deal, which is another sign that this company is going to bankruptcy. And oh, by the way, last month was the worst ever for junk bonds. So watch out here. The only hope remaining for the apes is a takeover, meaning Netflix or Amazon buying AMC. And that's not going to happen right now. When Netflix is down big, when Amazon is about to be down big, and AMC remains too expensive. It needs to go down to $5, $2, and then they'll be interested in buying the stock, or the company, I should say. Anyhow, we're moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have initial jobless claims for the week. We also have unit labor cost, the services PMI, the ISM services index, factory orders, and of course the confirmation hearing for the Fed zombies, the upcoming Fed zombies. And the problem here is Raskin. They don't like her. Senator Toomey came out today and said that Lisa Bloom Raskin will have troubles with the Republicans in the confirmation. Next, what do we have in the earnings calendar? More bombs to come, perhaps. We have Clorox, Eli Lilly, Honeywell, Merck, Amazon, Ford, and Snapchat. I don't see anything good here, folks. Maybe Clorox could pop higher due to the Pokemon, people buying Clorox wipes, who knows. When we talk about Amazon, that's the riskiest one. Ford, I own the stock, but I'm buying puts. It went too high too fast. Snapchat, this is the one that you got to watch carefully. If it opens down 20% as it's doing after hours and it did not report earnings yet, let's say after the bell Snapchat reports bad earnings, missing the top, the bottom line, who cares? The stock is already down 20% before reporting. The risk versus reward says it will probably pop higher. Keyword probably. So you might want to buy some calls here if Snapchat opens down 20% plus. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.